The following program is paid for by Lifespan Wealth Management, providing financial advice since 1993. At Lifespan Wealth Management, the main thing they do is provide retirement planning and advice and manage their clients' investment accounts. If you're looking for a financial advisor, contact their office at 478-922-8100 to set up your complimentary consultation. Lifespan Wealth Management has offices in Macon and Warner Robins for your convenience, and you can learn more about them by visiting their website at retirerelax.com. While you're on the site, visit the special reports section, which provides great financial education information on many different topics. You can also sign up to receive their digital feeds, which are short videos providing great information relevant to retirement, investing, and matters that affect your money. They also offer seminars to the community at no cost. If you're looking for a guest speaker for your church or civic organization, give them a call to discuss the topics you would like them to cover. Again, their contact number is 478-922-8100. Now, from the Macon studio of News Talk 940 WMAC, it's time for Your Money with Sherry Goss, Randy Goss, Jonathan Eisner, and Corey Albrecht.
Good morning, Middle Georgia, and welcome back to Your Money. And contrary to what was just said on the intro, it's just me and Jonathan here today. Sherry and Corey are out, and so I think we're going to do what? Football,
fishing,
car racing.
We talked about talking about cars and trucks.
So we'll just do that for an entire hour. See how many people we lose.
Or gain.
Yeah, or gain. Yeah, right. All right. Investors around the world breathed a sigh of relief after President Trump backed off his threats to impose tariffs on European countries over Greenland. However, risk remain. Denmark's prime minister said they cannot negotiate on our sovereignty. And after media reports of a potential compromise involving the U.S. Sovereignty over land for military bases in Greenland. More talks ahead in the coming weeks to determine what they're going to do.
Yep. Trump's comments at Davos caused a significant upward shift in the U.S. indexes earlier this week, led by the NASDAQ. European and Asian indexes also kicked up higher. Gold prices wavered after hitting record highs this week, and oil futures dropped about 1.8%. In corporate news, well-known companies reported earnings, including Procter & Gamble and GE Aerospace. Procter & Gamble shares rose, even though the maker of everyday goods cut its earnings outlook, which we're seeing a decent bit of that here lately with all these through-the-roof earnings reports.
And the way it's been this last year, somebody gives a not promising outlook,
right.
They normally get hammered the next day.
Right. Recent economic data came in a little stronger than forecast. Third quarter GDP rose 4.4% on an annualized basis, up from the prior estimate of 4.3%. Weekly initial jobless claims were lower than expected, right around 200,000. Okay, so who wants a humanoid?
I do.
Sign me up. Elon Musk plans to start selling humanoid robots to the public by the end of next year. Musk has already predicted that humanoid robots will eventually outnumber humans, which is a very scary thought. That means more than 8 billion of these things, if you think about it.
I mean, talk about creating new job opportunities. About
right.
Humanoid repair person, parts, the whole 9 yards.
Yeah. Hopefully that means a lot less expensive when robots are doing it instead of people.
At $8 million, you think you get a cost benefit there?
You would think so. Where was I here? With billions of machines deployed not only in factories but in homes as well, helping with everything from dishwashing to childcare. I don't know about trusting a robot to watch my kids or grandkids, but I guess we'll find out when we get there.
Right.
The rollout could start as soon as late 2027.
I think it's pretty exciting, but it's also scary at the same
both
time.
At the same time.
Right. All right. Have you ever heard of Mohamed El-Erian? He is an Egyptian-American economist and a business person. He was the president of Queen's College, Cambridge, and the chief economic advisor at Allianz, which is the corporate parent of PIMCO. And while he was there, he was also the co-chief investment officer. He was a columnist for Bloomberg and a contributing editor to the Financial Times. He is also seen on Fortune and CNN, and he's named 4 years in a row as one of the foreign policy's top 100 global thinkers. Well, El-Erian wrote in an article titled 2026 Outlook Calls for Recalibration. It's a very interesting article. For global markets, 2025 was defined much by what did not happen as much as what did. He says 2025 offered a masterclass in the power of a single narrative with massive concentrated bets on AI masking various unanswered questions. Yet, as we move further into 2026, the AI narrative is unlikely to prove strong enough to continue overshadowing other lingering uncertainties, many of which reflect deeper structural shifts. For investors, central banks, and governments alike, this situation demands adaptation.
Yep, and there were several economic developments in 2025 that served as direct rebuke to the conventional wisdom. Despite dire warnings of a lose-lose-lose trade war, U.S. tariffs did not trigger a stagflationary spiral or provoke as much retaliation as a lot of people expected. Even more surprising was the adaptability of China's export engine. By rerouting trade through non-U.S. partners, especially in Europe and Asia, China achieved a record-breaking trade surplus exceeding $1 trillion.
Yep.
Probably didn't see that one coming on the front end of the
Not on the front end of
tariff,
25.
right.
All right. And the U.S. consumers also proved extraordinarily resilient, especially low-income households, which continue to spend despite high prices, mounting debt, and growing anxieties about jobs and income. And when you combine that with investors' willingness to throw money at anything AI and to continue financing large deficits in the United States and other advanced economies, that resilience fueled a robust U.S. economy in expansion and generated beneficial spillovers for the global economy, with a third quarter growth accelerating 4.3%, which crushed expectations. Consumer spending, which accounts for 70% of the U.S. GDP, grew at a healthy pace of 3.5%. Spending on services such as healthcare rose 3.6% versus a 3% uptick on goods spending, including an increase of just 1.6% on the so-called durable goods, such as a car, that are meant to last for at least 3 years. A surge in exports and a drop in imports also contributed to a robust third quarter growth.
El Arian said that there are unsettling structural issues emerging in the U.S. where we are witnessing a decoupling of U.S. GDP growth from job creation, even in these very early stages of AI, robotics, and related technologies. Moreover, a widening K-shaped divergence is turning affordability into a volatile political and social flashpoint. The increasingly important influence on political implications is reflected in the Trump administration's recent focus on housing and energy. And globally, it's hard to see how other major economies, like Europe especially, can continue to accept the massive volumes of Chinese exports that have been redirected their way. The repeated breakdown of international policy coordination, vividly illustrated by the U.S. boycott of the G20 in Africa, confirms that the multilateral era is in the rearview mirror, at least for now. Has been replaced by a more fragmented landscape where geoeconomics dominate.
Yep. And never mind that closer coordination is needed more than ever to deal with a wide range of common challenges, both longstanding issues and new emerging issues. Wherever you look, the traditional factors underlying economic and commercial activity are likely to be increasingly sidelined by national security concerns, geopolitical and domestic political machinations. If 2025 was about ignoring the market spillovers of domestic and international policies, 2026 will be about navigating them. And then there's the U.S. intervention in Venezuela, which further complicated the geopolitical landscape. Such a sudden, largely unexpected development is likely to have multifaceted demonstration effects, meaning that this action will not only will it discourage smaller powers like Colombia, Iran, and Cuba from challenging the U.S., it may also encourage larger powers like China and Russia to consolidate their own spheres of influence on the basis of might makes right.
Under these new circumstances, the narrative of AI dominance looks set to lose some salience. The animal spirits that drove indiscriminate massive financing last year will increasingly be tamed by bubble fears that force investors to be more selective. The fascination with those working on AI will be tempered by the realization that the West is falling behind China and other parts of the Middle East in working with AI. Especially now, when we're on the cusp of a robotics revolution, widespread adoption will be key. He believes the integration gap will determine who dominates the next phase of global productivity growth, but it has yet to attract sufficient policy attention in the U.S. and Europe.
And for investors, the standard playbook will need to be changed. Riding a broad structural wave is no longer such an obvious and rewarding strategy. The 2026 outlook is likely to demand more tactical, bottom-up approach. Success will require identifying market completion opportunities, which refers to the potential for businesses to fulfill unmet needs or gaps in the market, leading to growth and profitability. For their part, governments and central banks must also recognize that they will no longer be saved by the private sector innovations and financing miracles. No longer will AI hype and ample funding offer a shield for policy failures. Interestingly, though, he says that the transition will be especially challenging for the Federal Reserve. The world's most powerful central bank must move beyond the overly rigid, data-dependent approach that has turned it into more of a volatility amplifier than a source of stability.
Yeah, that dynamic has been interesting in the last few years
that's
for
right.
sure
Yep.
to witness. But unless the Fed follows through on long-needed reforms to counter the forces eroding its credibility and effectiveness, its political independence will remain at risk. Across advanced economies, central bank changes will need to be accompanied by comprehensive growth strategies. High deficits and ballooning debt will prove far less forgivable in a world where the AI narrative is no longer loud enough to drown out lagging policies. Muted growth outside the U.S., especially in Europe, whose modernization is advancing at a snail's pace, will further contribute to political global instability. So no matter how you slice it, 2026 will bring more of the same. It should be a year of recalibration. I'm sorry, it will not bring more of the same. It should be a year of recalibrating for investors and for policymakers alike.
Yep. All right. If you're worried about the economy, though, and your financial stability, we have some advice for you. We know there's a lot of numbers and terms that get thrown around in our business and thus on this show, from labor statistics, the amount of money being collected through tariffs and how these tariffs affect the prices you pay, GDP and CPI, nominal versus real, earnings reports, and so forth. And to make matters worse, consumer sentiment is low. But one thing we know is that you can't control tariffs or inflation, but you can control your own financial security. You may start hearing economists use the term growth recession, and what that's compared to a normal recession is that where a normal recession is where the entire economy is shrinking. A growth recession is when the economy is still expanding, but just at a slower rate than it once was. In either case, the economy does not provide a sense of security. Neither news of the layoffs or companies not giving annual pay raises and a high consumer debt leave you with an uneasy feeling.
Yep, and we talked about the K-shaped reality on last week's show,
Right.
which is where the haves have more and the have-nots have not. They have less. And that diversion really creates very different perspectives and oftentimes reality. When you have that sinking feeling about your financial security, whether it's from a macro-driven events like a global recession or perhaps events that are more micro-driven events like your employer downsizing, in either case, you need to be prepared for these events. And the worst thing that you can do is put your head in the proverbial sand and pretend like nothing is wrong. You need a plan, and this plan is best executed before crisis hits.
That's right. And here's what you need to do. Reduce debt. That's probably one of the first things you need to think about. And start paying for purchases with cash if possible. Debt is a burden, and you need to get rid of it. The less money you owe every month, the less pressure you're going to feel when the economy does take a turn. You need to build up your emergency savings. This needs to be a priority. You don't want to get into a position that would require you to use your credit cards to survive if you lost your job, because racking up the debt during a crisis is a surefire way to magnify the stress you already have during an already stressful time. Cash is king, and it can help you weather the storm.
Yep, focus on your financial security. If you're suddenly thrown into a bad situation, it's imperative that you know how to be financially conservative. Review your spending by tracking what you spend for 30 days. We talk about this all the time, and Sherry likes to talk about writing it down.
Yep, she
Don't
does.
put it in an app. Don't let something else track it for you.
Yeah, and plus, we both do, really. We like having that steno pad laying on the counter.
Yeah.
You come in, you write everything down because it gets lost in an app. When it's,
For sure.
when it's on a piece of paper, you can actually just sit there and look at it and kind of make better decisions, I think.
Right, and she's right when she says that when your body, when your mind and your physical actual muscles force you, is writing something, you remember it better. It sticks with you
Yep.
better. So then identify areas where you can reduce your after you track for 30 days. Then identify areas where you can reduce cash outflows.
Right. And we encourage you to conduct this exercise at least once a year. And it's amazing how many unused subscriptions you may have and how much money you're spending on eating out or how much your auto insurance costs. This exercise can help you right-size your budget. And just remember that you need to control what you can control. And being financially prepared for life events goes a long way to reduce the stress that generally comes with these life events.
As they say, this is low-hanging fruit. Getting your financial house in order is a critical step, in at least in terms of what you can control,
That's
like
right.
you're talking about. All right, so here's a concept: reversion to the mean. John Clifton, Jack, he goes by, Bogle, changed how ordinary people invest. As the founder of Vanguard and the creator of the first index fund available to individual investors, He spent his career championing low-cost, long-term investing over Wall Street's expensive short-term speculative investing. His straightforward approach has helped millions of people build wealth without needing to beat the market or pay hefty fees to fund managers. In his final book, The Clash of the Cultures, Investment versus Speculation, Bogle distilled 6 decades of investment wisdom into 10 simple rules. The very first rule might be the most important, and that is, remember reversion to the mean. It sounds simple enough, but this single concept, if truly understood and applied, could save you from some of the most devastating investing mistakes.
That's right. That's right. So what is reversion to the mean? Reversion to the mean is the tendency for extreme performance to move back towards the average over time. In investing, this means today's market darlings tend to become tomorrow's disappointments and vice versa. But here's what makes the principle so powerful. Reversion to the mean isn't just a pattern we observe, it's practically inevitable. The same forces that create outperformance contain the seed of its own reversal. So if you look back at how different asset classes have performed over the last 15 years, you would see how each fared from year to year. For example, REITs led 2021 with a 41.3% return and then plummeted to a negative 25% on the following year. Emerging markets jumped from negative 14% in 2017 to first place in 2018 with a 38.8% return and then crashed again. Small cap stocks swung from leading in 2016 to near bottom in 2018. And in 2022's downturn, cash was the only asset with a positive return. So if there is a reliable way to predict which asset classes would lead next year, someone would have figured it out by now. Instead, we see what looks most like a random shuffle.
Yep.
Now, I'm not sure if you've ever seen this. It's a list of all the mutual funds, and it's like a Skittles chart. You know, it's got all different colors, and you can track a certain mutual fund through its life cycle. You know, like by year to year. So, and it's exactly what he's talking about. One year you see it at the very top, and the next year is in the middle or at the very bottom. So,
yeah. A lot of times you see those charts with asset classes,
That's right.
or portfolio mixes.
That's right.
And like 60-40 is the classic, go to, especially for retirees. And you see these charts, Skittles charts, where maybe 80-20 is the highest one
That's
year,
right.
but the next year it's the dog.
The 70-30 or the next.
The next year might be 60-40, or
Yeah.
the next year it might be commodities or
That's
something
right.
like that. So this is all very good stuff. Reversion to the mean is the concept here, but the same pattern plays out across sectors, which is what we're talking about right now. So equal weight sector energy stocks were the worst performing sector in 2020 at negative 34%. Then shot to first place the very next year at 54%, 2021. And they stayed on top in 2022 with a 65%
That's
return.
a giant swing.
That's huge. Imagine getting in at the bottom in 20,
Yeah.
and then at the end of 22, that's a Merry Christmas right there.
You start thinking you're invincible then.
Yeah, right. Real estate jumped to second place in 2021 with 46% before crashing to negative 26% the next year in 2022. Communication services went from middle of the pack to leading in 2023 and 2024, while information technology has dominated 4 of the last 6 years. Year after year, the colors on these charts shuffle like a deck of cards. What was on top falls, what was on bottom rises. The rotation doesn't ever stop. And this isn't random noise. There are structural reasons why reversion to the mean is practically inevitable. Consider a company growing earnings at 50% a year. Exciting, right? But if that growth rate continued indefinitely, the company would eventually become larger than the entire stock market, then larger than the entire economy. Obviously, that cannot happen. Growth rates slow because they must.
That's right. Or think about small cap stocks. If small caps outperform large caps every single year, they wouldn't stay small for long. Either way, they'd grow into large cap stocks, and their prices would get bid up to the valuation that can't possibly be sustained. So, the outperformance sows the seeds of its own ending, like we said before.
Right. Commodities make the mechanics especially clear. When coffee prices surged 87%, like they did in 2024, farmers around the world plant more coffee trees. When oil prices spike, drilling rigs that weren't economical at lower prices suddenly become profitable. New supply comes online. Eventually, that additional supply pushes prices back down. The high prices themselves create the conditions for lower prices.
That's right. The same dynamic plays out in the stock market sector. When a sector gets hot, valuations stretch until the prices reflect expectations that are nearly impossible to meet. Capital floods in, competition increases, and eventually disappointment follows.
This is why reversion to the mean isn't just a statistical curiosity. It's baked into how markets and capitalism actually work.
Yeah, and with this, you can see that there's a reason. There's a lesson in diversification here. When you diversify broadly, you're not trying to guess which asset class or sector will win next year. You own them all. You'll always have some holdings that are lagging, but you'll always have some that are leading. The overall result is a smoother ride towards your financial goals.
Yeah. And we've done this in recent years. We've for the sake of diversification, ventured more into some mutual funds and some ETFs than we have
like spiders
historically done as a firm. So the lesson here is that if you understand why reversion happens, it should change how you invest. And with that, there are two broad brushed ideas here that you should take note of. One, be skeptical of whatever is hot right this minute. When something is dramatically outperforming, ask yourself, what would have to happen for this to continue? If the answer requires growth rates that would make a company bigger than the economy or valuations that assume perfection forever, you're probably looking at the late stages of a run, not the beginning.
And you can think meme stocks here too.
Oh yeah, for sure.
That was happening a lot in 2024 and 25.
Made money, but probably a lot more people lost a lot of money.
You seem to only hear about the people that make the money.
Right.
No one wants to admit to the losses they've had.
Right. Number two is to diversify broadly. If you own the entire stock market, you don't have to guess which sector or asset class will outperform next. You own whatever is winning at any given time, and you won't be caught holding concentrated positions when reversion arrives, which inevitably it will. Final thoughts. Bogle put it best. What's hot today isn't likely to be hot tomorrow.
Yeah. And this isn't pessimism or market timing advice. It's recognizing that markets have built-in mechanisms that pull extreme performance back towards the normal. Growth rates slow because they must, and valuations correct because the alternatives emerge. Increased valuations bring new supply and competition. So the next time you see a spectacular return somewhere in the markets, remember that the very force that created those returns are already working to end them. The means always wins eventually.
Right.
So
you've been listening to Your Money, brought to you by Lifespan Wealth Management, proudly serving Middle Georgia for over 30 years. Our mission? Helping folks just like you plan for a secure and stress-free retirement. Need a trusted financial advisor? Call us today at 478-922-8100 and schedule your complimentary consultation at our Macon or Warner Robins office. Want to learn more? Visit us anytime at retirerelax.com. Because when you plan smart, you can retire and relax. And here's something extra. We offer free educational seminars for the community. If your group needs a guest speaker, give us a call and let's make it happen. That's 478-922-8100. Now, let's get back to the show.
all right.
Okay, so we talk about this a lot, but here, when we have actual numbers from studies, it's always, I think, informative and good for people to be aware of so that this doesn't happen to them.
And this next little article we're going to talk about is extremely important for people who are still working. Actually, if you've retired too, and you've had a 401k or some other employer contribution program, because there's so many of these things being left behind, billions of dollars.
Right.
And think about all the people who have literally nothing saved, like in an emergency savings account. If they could find something that's got their name written on it,
Right.
it would be a nice windfall.
Right. So this latest study, which is from PensionBee, says that nearly 1/3 of all workplace retirement accounts may be zombie 401ks, they call them. Nearly 1 in 3 workplace retirement accounts may sit dormant, according to the new research released by PensionBee. The study, which analyzed U.S. Department of Labor, or DOL, data from 2012 to 2023, reveals that the growth of forgotten or left behind 401k and 403b accounts has significantly outpaced the growth of active accounts opened in the last decade. So think about that for a second. New accounts opened, which have gone up proportionally, are being outpaced by accounts being left behind or dormant.
And and we're going to talk about this a little bit, but it is a success story to have more people getting these 401ks and 403bs open, and a lot of it is automated by the employer.
Right.
But a lot of people don't understand what they have, or never invested, and so they get in. The employer's putting money in, they don't, so they don't see that they have money coming out of their paycheck going into these accounts, and when they walk out the door and go somewhere else, they don't think twice.
For sure. And for a lot of people, it's so out of sight, out of mind, out of sight that they might get statements, their quarterly statements for their 401k, and throw them straight in the trash.
Yeah, because
they have no clue.
They have no clue what it is. We have clients who throw their stuff in the garbage.
But at least they have us to direct them.
That's right.
Or guide them. So research highlights a troubling paradox, which is what Randy's mentioning here, and that's that while 401k adoption is on the rise, a record number of Americans are losing track of their savings as they move between jobs. This is a quote from somebody at PensionBee. 10 years ago, 1 in 5 accounts was reported to be dormant. This year, that number is much closer to 1 in 3. While growing 401k participations is a success story, we cannot allow zombie accounts to undermine the retirement security of millions. These funds often face higher fees and stagnant growth, trapped in plans where they are no longer a priority.
And, I will add something else to this, too. You just acquired a new client yesterday that is consolidating a bunch of old 401ks and mutual funds and from different firms that her husband had over the years. And, when people pass away, if the person who dealt with the finances most often takes that knowledge with them to the grave, then the spouse is left there with wondering how they're going to survive. And they may have a lot of money sitting in accounts they just don't know anything about.
Right.
And which is one of the reasons we wrote the Life book. Sherry wrote it 20 years ago, and it's still up to date today. It allows you to put all your information in one place so that your executor, heirs can find that and at least be able to find the money. So,
right.
All right. PensionBee's analysis of over 11 years of federal reports reveal a surge in dormant accounts, and their key findings include dormant workplace retirement accounts doubled between 2012 and 2023 to just over, rising from 14.8 million to 28 million in just 11 years. In 2026, they are expected to reach 32.8 million. While active 401ks grew by 44% between 2012 and 2026, the number of dormant accounts accelerated nearly 3 times faster, ballooning by 130%. And by the end of 2026, over 30% of all funded workplace accounts could be dormant, up 21%. The cost of inaction can cost you money. As the average American worker changes jobs more frequently, the risk of compounding loss intensifies. While leaving behind a 401k is not inherently bad, the practice can be costly. Previous PensionBee research found that a seemingly small $4.55 monthly fee on a forgotten account can snowball into nearly $18,000 in lost wealth over a career. That's real money.
When you look at the numbers that way, it hits for sure. Under the current Secure 2.0 regulations, Secure Act, that is, Secure 2.0, employers can automatically roll over left-behind accounts with balances under $7,000 into safe harbor IRAs. These accounts are often parked in cash-equivalent investments that may fail to keep pace with inflation, risking stagnation or erosion, in some cases down to $0.
Yep.
More Americans gain access to retirement benefits through work every year, but access is really just the first step. Auto-enrollment without auto-portability will only increase the likelihood of forgetting about that plan.
That's a good point. So if your employer has a workplace retirement plan, you should learn all you can about the plan, its contributions, and matching limits, as well as what you need to do if you leave the company.
Yeah. Here are 4 simple moves to safeguard your retirement and prevent retirement savings from drifting out of reach. Number 1, find old accounts. Do it yourself with the DOL's Lost and Found database, or find a retirement provider that can track down lost accounts on your behalf. Number 2, consolidate old accounts into a single IRA or roll over into your new employer 401k. Number 3, review, and I would say do that sooner than later, because
Absolutely.
The more time that passes, the more likely you are to forget that
That's
it's
right.
out there. Number 3, review and optimize investment allocations regularly, or choose a target date portfolio that rebalances automatically.
And I would say that people who don't know a lot about investing, if they have a 401k or a 403b, they need to understand what they're invested in and how to go about making those changes.
Right.
And get on your phone and your computer and look up these funds and understand what they're about, what you're invested in, what the returns have been historically, and take a look at the overall macro data to help make a better decision.
Yep, for sure. Last but not least, number 4 is automate your contributions. This ensures consistent saving. After all, this is your money.
Yep. All right. Next up, the IRS issues revised sample notices to recipients of IRA rollover distributions. The Internal Revenue Code is Section 402F, and it requires plan administrators to provide certain information to recipients of eligible rollover distributions in advance of making the distribution. The purpose is to advise the recipient of their ability to roll over the distribution into another employer plan, if the plan allows it, that is, or into an individual retirement account or an IRA. And the income tax withholding that will apply if the employee doesn't roll it over. The IRS provides 2 sample notices that plan administrators may use, one for eligible rollover distributions from designated Roth accounts, and the other is for eligible rollover distributions.
Yep, there are several a new exception to the 10%. There are several. A new exception to the 10% additional tax on early distributions where these distributions aren't treated as eligible rollover distributions for purposes of the direct rollover rules, or the notice requirement or the mandatory withholding rules. Those exceptions include early distributions for distributions to 1. Qualified public safety employees and private sector firefighters after separation from service after the earlier of age 50 or 25 years of service. Next, state and local correction officers and forensic security employees who provide for the care, custody, and control of forensic patients. Next, emergency personal expenses. Next, terminally ill individuals. Qualified disaster recovery. And last, qualified long-term care distributions. If you're in one of the positions or situations I just mentioned, be sure to check out the IRS code that Randy just mentioned a minute ago. That IRS reference was IRS code 402F.
Yep. All right. Let's talk about the retirement crisis that no one warns you about, mattering honestly. Many of us plan for our future wealth and health. Few prepare for an equally essential aspect of retirement, how to continue to feel seen and valued. One personal story in this article discussed a couple, we'll call them Nancy and Dean, who had just retired and moved to a retirement community in Sarasota, Florida. They joined a small group of recent retirees for dinner. And when the former medical dean that she was talking to asked Nancy, who had just stepped away from a 40-year career in higher education, about her retirement plans, she told him that she hoped to consult with a local nonprofit and find ways to contribute. The former dean, gave her a weary smile and told her that he had hoped to assist in teaching a biology course after retiring. He said that every attempt had gone nowhere. And around the table, heads nodded. Despite decades of expertise, each person there was stunned by how hard it was to find a meaningful way to contribute after winding down their careers.
What these retirees were describing wasn't just disappointment and a lack of opportunities. It was an erosion in something far more fundamental, that being their sense of mattering, the deep human need to feel valued and to have a chance to add value to the world. We plan for our wealth span and health span, mapping out financial security and physical well-being. Yet very few of us prepare for an equally essential dimension of retirement, the mattering span, or how we will continue to feel seen, useful, and capable of making a difference in this next chapter of life. The consequences of neglecting our sense of mattering are measurable and profound. A study published in the journal Healthcare is the journal, drawing on data from over 3,000 retirees, found that nearly a third experienced depressive symptoms, with higher rates among those pushed into retirement by illness, layoffs, or mandatory exits. Other studies indicate that the psychological losses often embedded in retirement, such as feeling less valued, needed, or connected, are strong predictors of post-retirement depression.
Yep. And more than 11,000 Americans turn 65 every day. By 2030, 1 in 5 will be of retirement age. As we live longer, sustaining a sense of mattering has become a defining challenge of aging. Research suggests that it's time to shift the question from how long will I live to how long will I continue to matter while I do. Mattering is a sense that we are valued by others and that we have value to add to the world. Introduced as an academic term in the 1980s, it has gained new relevance in the recent years as rates of anxiety, burnout, and disconnection have surged. Researchers across a variety of fields view mattering as a missing pillar of the well-being.
At its core, mattering answers a fundamental question: does my life make a difference? Evolution shaped this need. For our earliest ancestors, being valued by the group meant safety, while being ignored meant danger. The ancient wiring persists today. When people feel they matter, they thrive. When they don't, they suffer. In one study of suicidal men, 2 of the most common words used to describe their distress were useless and worthless. To understand how to deal with the problem, it's useful to think of mattering as having 4 main components: feeling significant, appreciated, invested in, and depended on. These ingredients offer both a diagnosis and a solution for strengthening your mattering span at any age.
They're all important.
They are.
A 2024 study of 748 adults found that while most retirees plan carefully for their finances, fewer than half give real consideration to what their lives will be like once they stop working. Lifestyle planning, not financial preparation, was the strongest predictor of retirement satisfaction. The most significant challenges retirees reported were psychological and social, such as boredom, a loss of structure, and a diminished connection. In other words, the researchers concluded that retirees needed a deliberate strategy for staying connected and engaged in the decades ahead.
Yep, and here's the power of invitation and purpose. Many life transitions, like retirement or widowhood, divorce, empty nesting, those come with an unexpected loss of social anchors. A retired teacher who was interviewed for this article said that she missed the brief hallway chats and luncheon check-ins with her colleagues that she'd once taken for granted. Without them, she felt cut off from the daily connection her work had provided her. What changed everything, she said, was deciding to say yes to every invitation that came her way, like coffee with a neighbor, joining a book club, etc. Each yes helped her rebuild the connection that she craved.
And one place to start is with the modest goal of saying yes to an invitation or extending one once or twice a week. And remember, an invitation isn't just about you. When someone reaches out to you, they are taking a small risk in their bid for connection. By saying yes, you're signaling to them that you value them. In this way, extending or accepting an invitation becomes a mutual exchange of mattering. To experience the benefits of mattering, we need to feel valued, but we also need to feel the opportunity to add value again. Research increasingly shows that having this sense of purpose plays a central role in retirement satisfaction and mental health. But purpose alone doesn't capture the whole picture. What retirees often search for is the experience of being depended on. The people who regain that sense of being needed tended to follow a simple, repeatable pattern. They identified genuine need and met it with the 3 T's: time, talent, and treasure.
All of us will face life transitions that can rattle our sense of mattering, but we can begin to rebuild that sense by making ourselves useful. The way back can start small, inviting a lonely neighbor to coffee, checking on someone going through a hard time, or lending a hand to a family that's stretched thin. What you might find is that the fastest way to feel like you matter is to show someone else that they matter.
Absolutely.
It's a great concept.
It is. It's a great article, too, and it really is a very much needed thing for people to realize before they do get to the point where they just walk out the workplace door, that life's going to change for you.
Right.
I mean, especially if you are a central figure in that office and everyone relied on you, and you walk out and you have nothing to do but go home and watch soap operas and cut the grass.
Right.
You are going to have an empty feeling in your stomach. So
yes,
it is very important to develop this before you decide to retire, as this article says. All right.
And it's not just retirement, because as we've seen the last 5 years, a lot of people work from remote now.
Yep.
And I have run across several. I've run across several people, personal friends, in some cases, where there's no sense of fulfillment.
Yeah.
You don't ever even have to leave your front door during the day, and you sit in front of a computer, maybe, or maybe you don't, because you're remote and you can get away with not doing a whole lot of work.
And the other thing too is we all, and you see how many packages we get here. Sherry and I personally, everything comes to our office.
Right.
We don't go out and shop much anymore. And when you go out and shop, you have the interactions with the people that you're bumping into in the aisles.
Yep.
The cashier. You do get out and interact with people, and it's little things like that help you stay satisfied. But doing it on a deeper level, when you're getting out with someone and having a nice cup of coffee with them, I think that goes a long way.
I don't remember the gentleman's name, but you may remember it was probably 6 months ago. I wrote up a story about a gentleman, and I cannot remember his name, who intentionally went out and about to mail things to people. And his friends would be like, you can just get digital stamps and drop that in your own mailbox, right? And he said, yes, I know that. He said, but then I don't get to see the fireman working at the fire station when I drive by there, or I don't get to see the neighbor walking her dog and put my window down and speak to him. And this gentleman, I wish I remembered his name. It was such a great story.
Yep.
Because he had such a good grasp on missing out on the little things in life just because they're so convenient now to miss out on. getting stamps digitally and just drop it in your own mailbox.
I couldn't imagine working from home, and I have that option. I can run the portfolio from anywhere. But I enjoy coming in here,
right?
Socializing with you and Corey and Tia and Kathy, and then get to, occasionally get to meet the clients when they come in.
I thought you were going to say, and occasionally socializing with Sherry also. Who? Yeah, right.
Yeah, but it does mean something. So try to get out and socialize, and not just for yourself, but for someone else, because I think it goes a long way.
For sure.
So,
for sure.
All right. Moving on. As tax season approaches, the IRS impersonation scams are surging. As the Internal Revenue Service and taxpayers gear up for the start of tax filing season on January 26, the scammers have been ramping up too. According to the Federal Trade Commission, or the FTC, there has been a surge in consumer reports of phone scams posing as the IRS or so-called tax resolution agencies with official-sounding names such as Tax Resolution Oversight Department or Tax Mediation and Resolution Agency.
Fancy.
Yeah.
Sounds very fancy. These calls are not from the government and are designed to pressure you into providing your personal information or handing over your hard-earned cash to settle some fictitious back tax bill.
Yep. Now, here's how the latest scam works. The scam typically begins with an unexpected phone call or a voicemail, the tax mediation or the resolution agency, or another official sounding name, but they're fake. Government agencies claiming that you haven't paid your taxes. Often the caller warns that this may be the final attempt to reach you. They may say that you qualify for a special IRS liability reduction program or offer to connect you with a tax resolution officer who can run a red flag check on your credit.
Some scammers will leave a voicemail saying, "This may be our only attempt to reach you," hoping that you'll call back, that you'll feel some urgency and call back right away. None of these programs or titles actually exist. They're part of a script meant to sound urgent and official, so you'll act quickly instead of verifying the false claim. They're attempting to steal personal information like your social security number, bank account number, etc. Remember that the IRS will not initiate contact with you by phone, text, email, or social media. If you owe taxes, the IRS will first reach out by mail. A surprise call about your taxes is a signal that something isn't right and a good reason to hang up immediately.
That's right. If you receive a suspicious call, text, or email, don't engage. Don't click links, and don't return phone calls or share personal financial information by phone or email. Scammers rely on social interaction, so the less you engage, the less likely you are to become a victim. Hang up, block the call, the number, or disconnect immediately.
In addition to refusing to engage with scammers, you can help stop these scams by reporting them. You can report the fraud by forwarding the message to phishing@irs.gov, and that's phishing with a PH, PHISHING at irs.gov. You can also file a report with the Treasury Inspector General for Tax Administration, or the TIGTA, TIGTA, which investigates IRS impersonation and tax scams. Unfortunately, as of this writing, the reporting page on TIGTA's website is not available. If you're not sure a message is legitimate, I always recommend going directly to the source rather than relying on the message's information. If it's a federal tax-related message, you can call the IRS at the official number, which is 800-829-1040. Interesting that their last four numbers are 1040.
I think they did that on purpose.
I'm sure they did. Or check your online IRS account at irs.gov, G-O-V. Any notices that have been mailed should also appear in your online account.
Yep, and not every scam begins with an email or a text. Some start with an online search. When people look up tax information, like checking for tax refund statuses, scammers maybe use sponsored ads or manipulated search results to direct them to fake websites that closely resemble the official ones. To reduce that risk, it's best to navigate directly to the irs.gov website or other official sources rather than clicking on the search results. Bookmarking trusted sites can save you time and prevent mistakes later, too. The same caution applies to mobile apps. Only download apps from the official app store and always check the developer information to confirm it was actually associated with the IRS. A familiar logo alone is not enough.
No, definitely not. It's too easy these days to mimic a logo. If you really do owe back taxes and don't know how you're going to pay the debt, steer clear of scammers who may try to take advantage of you. Consider setting up a payment plan directly with the IRS for your federal taxes or your state comptroller for your state taxes, or work with a trusted professional. The FTC also advises you do not do business with anyone who tells you to pay their whole fee up front or charges you a pricey monthly maintenance fee to resolve your outstanding tax issues. If you think you may have clicked a malicious link or shared information, act quickly. Close the website or message immediately and avoid sharing any further details.
Yep, and if you're prompted to log into an account such as email, banking, or other sensitive services, change your passwords immediately and enable additional security measures if available. It is important to contact your bank and your credit card provider so they can monitor for fraudulent transactions.
So how can you protect yourself? Here's what the FTC suggests. Don't give your personal or financial information in response to a request that you did not expect. Honest organizations won't call, email, or text to ask for your personal information, like social security numbers, bank account numbers, your PIN. If you get an email or text message from a company you do business with and you think it's real, don't click. Instead, visit their official website. Government websites always end in .gov, like irs.gov, or call their official number. Don't call the number they gave you or the number you see on your caller ID.
Right. Don't cave to the pressure to act immediately. Honest businesses will give you time to make a decision. Anyone who pressures you to pay or give them your personal information is a scammer. Don't trust callers or services who tell you exactly how to pay. Never pay someone who insists that you can only pay with cryptocurrency, wire transfer services like Western Union or MoneyGram, or a payment app or a gift card. And never deposit checks or send money back to the person who gave you the check. Stop and talk to someone you trust. Before you do anything else, tell someone like a friend, a family member, or a neighbor about what happened. Talking to it could help you realize that it is a scam.
Finally, if you were scammed or think you saw a scam, report it to the FTC. Bottom line, scammers depend on fear, urgency, and official-sounding language to succeed. Staying calm, verifying information at the source, and refusing to engage with unsolicited text messages can keep your personal information safe.
Yep.
When in doubt, always assume it's a scam.
And you may wonder why we talk about scams so much, like every week. It's because scams cost businesses nearly 8% of equivalent revenues, according to TransUnion, and $64 billion was lost to scammers in 2025, and that's for the individuals, not businesses. That's $64 billion lost, and that number counts only the reported scams. Those that do fall victim report losing more than $1,000 on average. And we do the Scam Alert and training on how to manage the barrage of scammers working so hard to get at your money in hopes of helping you be more aware of this topic.
This week's Scam Alert, warning, the hidden danger of cheap flights and why an innocent passenger was banned by Alaska Airlines after booking a cheap flight online. Let's start with, if it looks too good to be true, then it probably is. That's the famous saying that one Alaska Airlines recently learned the hard way when he was denied boarding. Had the cops called them and then received a letter from Alaskan Airlines a few days later informing him that he was placed on the carrier's no-fly list. The passenger, however, did nothing wrong per se. In fact, they very likely fell victim to an increasingly popular fraud that is popping up on Facebook despite attempts from the social media giant to stop the problem. So what exactly happened? After checking in, the man was flagged by Alaskan Airlines. The gate agent sent him back to the ticketing desk to sort out an issue with his reservation. At that point, the man was asked to hand over the physical credit card he used to pay for his ticket.
Yep, but there was the big problem right there. The man had booked the ticket through an online travel agent, and the card used to pay for the flight didn't match the one that Alaska Airlines had on file. The airport agent started accusing him of fraud and then refusing the service, even calling the cops. While the letter didn't explain why he was placed on the no-fly list, it did make the consequences of what happened very clear. The man was barred from flying on Alaska Airlines Group airline, and that also included the Hawaiian Airlines. The passenger was likely the victim of an increasingly popular fraud, which online travel agents resell tickets at big discounts, sometimes using stolen credit cards or frequent flyer miles.
In some cases, these online fraudsters run through through huge numbers of stolen credit cards until they finally get one that hasn't already been canceled by its legitimate owner. In other cases, fraudsters hack frequent flyer accounts and steal miles to book tickets. There are also cases of frequent flyers selling their miles to these fraudsters to make a quick buck. Sometimes older travelers looking for a budget price ticket will not always know how to spot fraud online. And many people are accustomed to booking through a third party like a travel agency, so at first glance, it appears legit. Anyone, not just older people, can become victims of these frauds while they are bombarded with seemingly legitimate-looking ads on Facebook or somewhere else that offer incredible flight deals. Alaska Airlines has not publicly commented on this specific case, but Airlines typically freeze tickets when fraud indicators are detected.
Right. And the bottom line is some of these online travel agencies advertise their services through Facebook ads, while others even appear in listings on Google Flights. There's a massive where there's a massive discount that is clearly displayed against the price to book directly with the airline. While some of these online travel agents are legitimate businesses, users have reported problems and airlines are becoming increasingly wary of sketchy third-party services. So rather than taking a risk that you could see your reservations go up in smoke, book directly with your airline or through a legitimate and established online travel agency like, say, Expedia, Priceline Bookings, or Hotels.com.
Yep. So. All right, last article, 5 financial blind spots that burden grieving spouses. Losing a spouse is a profound emotional blow. It often triggers a second crisis, which is a financial fog of legal hurdles and hidden tax traps. From being locked out of assets to facing a, quote, widow's penalty that can raise tax rates, the transition from a partnership to solo financial management is fraught with potential cost. The Wall Street Journal asked financial planners and other experts for their advice on ways to help ensure a grieving spouse is prepared for the road ahead. First is surprise debt. Chris Bentley, a financial advisor, says that survivors are often surprised to discover that the late spouse had individual credit card debt. He recalled one widow who found a $5,000 balance on a store card that was in her husband's name. Bentley advised the widow to notify the creditor of the death, and the company chose to discharge the debt. Creditors often find it more cost-effective to write off smaller debts than to pursue them through formal probate process.
Yeah, and in many states, if a card is only in one spouse's name, the survivor is generally not legally obligated to pay it, but rules vary. In community property states such as California and Texas, spouses might be liable for the debt incurred during the marriage, even if they didn't sign for them. So the next one is being locked out of accounts. Assets owned solely by the deceased must go through probate before they can be transferred to a surviving spouse. And in some counties, this can take more than a year, leaving the spouse locked out of necessary funds. To avoid these delays, you can do the following. You can set up a revocable trust. Assets in these funds don't go through probate. Joint ownership. Property and accounts held jointly transfer automatically to the survivor. And you would need to set up TOD or POD designations on each of these accounts. That's the bank or the brokerage or the brokerage firms. And that allows the money to immediately transfer upon death. And individual liquidity is the next one. Each spouse should maintain enough money in his or her own separate account to cover the cost for monthly expenses.
Yep. Another issue is that widows are sometimes surprised to find that they have little or no personal credit history. If one spouse handled all credit cards and loans, the survivor might appear essentially invisible to credit bureaus, even with significant household assets. Because credit systems track individual borrowing rather than household wealth, this lack of history can make it difficult to refinance a mortgage or qualify for a credit card. To avoid this, both partners should maintain active credit in their names.
Yep. Widows are often surprised at the cost of the previous lifestyle. When one spouse handles all the money and budgeting for the home, or the spouse took no interest in the financial matters, the cost of living expenses can be a big shock. From the cost of insurance, to car payments, housing, children, tuition, and smaller recurring costs such as subscriptions, and in many cases, returning to work to generate the income is required. To avoid being blindsided after a spouse's death, it is recommended that couples meet monthly to review their finances. If a spouse won't commit to learning the details, it is especially important for the other spouse to keep detailed records for the survivor. Another change many don't anticipate is going from filing taxes jointly as a married couple to filing individual.
Even if one Social Security benefit goes away after death, people with survivorship pensions and required minimum distributions on other retirement accounts can find themselves in a higher tax bracket. The situation is known as the widow's penalty, as I mentioned earlier. A survivor can usually file as married filing jointly for the actual year the spouse died. If there are dependent children, the widowed partner might qualify as a qualifying surviving spouse for up to 2 years following the year of death.
Yep.
So we don't have time for this last one.
No.
So I'll interject for a second
Okay.
and just talk about some real life things that happened this week, if that's okay.
That's fine.
We got about a minute left. 2 different cases this week, real life of how we operate with prospective clients, okay? One gentleman came in earlier this week, very smart, very savvy, came in, he had all his stuff written down. He's been saving himself for years. He knows exactly where, which buckets his money's going to, how they're going to be affected tax-wise, et cetera. I went over our fees with him and said, this is how we charge clients for us to manage assets for them. He promptly wrote me back the next morning. He said, thanks, but no thanks. I wanted to go ahead and let you know before we follow up and not waste any more of your time. I can appreciate that.
Right.
The guy's smart. He's got a good head on his shoulders. I think he's going to be fine.
Yep.
Another case you mentioned, a lady. She's a widow. She has no clue about any of this stuff. It was well worth the fee we're going to charge her, not for the management of the assets, but for help with required minimum distributions, taxation, things she has no clue about. So real life examples of hiring an advisor. Have a great weekend, everybody.
Thanks for listening to Your Money, produced by Lifespan Wealth Management. As financial advisors, the main thing they do is provide retirement planning and advice and manage their clients' investment accounts. If you're looking for a financial advisor, please contact their office at 478-922-8100 to set up your complimentary consultation. You can learn more about them by visiting their website, retirerelax.com. And if you have a question or a topic that you would like them to cover in next week's broadcast, you can email Randy at rfmoney.com. They look forward to connecting with you next week. Have a great weekend, everyone. Securities and investment advisory services offered through Osaic Wealth Incorporated, member FINRA SIPC. Osaic Wealth is separately owned, and other entities and or marketing names, products, or services referenced here are independent of Osaic Wealth.